What I want to talk about today are cash value collateral loans, what they are, how you can use them, and at the end of this video, we're going to look at some numbers that demonstrate exactly how these loans work. What they involve is using a whole life insurance policy, and instead of borrowing directly against the policy, which we're going to look at a direct comparison in this video, but instead of borrowing directly against a policy, we can leverage our policy with a bank or third-party lender that will grant us a loan, typically in the form of a line of credit, using our cash value as collateral. Now, before we get into the meat of this video, what I will begin with is that there are a number of names for this product. One, we will hear cash value collateral loan, we'll hear cash value line of credit, we'll hear insurance-backed line of credit. They're all the same thing. So let's get on into it. To begin, it involves using a cash value life insurance policy. Most banks and lenders are most comfortable with whole life products. Some lenders will experiment with universal life type products, but most want to use whole life insurance products for the simple reason that you've got a guaranteed rate there that always exceeds the insurance expenses, and they know that the value goes nowhere but north over time. So if we were to look at a standard loan, meaning you have a whole life insurance policy and you're considering borrowing against it, let's assume you've got $100,000 in cash value. The net growth rate, being the internal rate of return, will range somewhere between 3 to 5% over the life of the policy. Remember, in the early years of a life insurance policy, I have a negative internal rate of return, meaning you have less money in cash value than what you paid in. We're going to look at a model in this video. But typically, the historical growth rate is a little bit higher than 3 to 5%, but I like to peg it a bit more conservative just based on the interest rate environment we're in right now. So let's assume that you have a policy that is going to produce an average internal rate of return of 4% over the life of the policy. We're going to look at the growth rate year over year in the models, but let's just assume 4% for simplicity. On average, with a life insurance policy, if you're going to take a direct loan against your life insurance policy, you'll see a 5% interest rate or a cost to borrow. Now, anytime you loan from a life insurance policy, the interest goes to the insurance company. 5% is the average. Depending on when you started that policy, though, that interest rate with your life insurance policy may range between 3 and 8%. I've got an older policy that still has a loan interest rate of 8%. That's the fixed loan interest rate. So depending on when you started your policy and if you had a fixed or variable loan rate, that loan interest rate may range or likely does range. But whatever the loan interest rate is, if it's 5%, which is typically the average, that does go to the insurance company. So that's a standard loan. Getting into the cash value collateral loan. And what I'll add as a quick side note, this is most common, or I should say they are most popular among real estate investors and business owners. And you'll see why as we progress through this video. So what a cash value collateral loan is we are obtaining basically a line of credit from a bank. I'm taking a whole life insurance policy, whatever my cash value is, say it's $100,000, and I'm going to the bank. Let's pretend you're the bank. I'm saying, I've got this $100,000 in cash value. I'd like to assign it to you as collateral, and you, the bank, give me a line of credit, which I can then draw on at my leisure, very similar to a home equity line of credit. Now, a couple bullet points here. The cash value is what is collateralized. So I have a collateral assignment on my policy. I'm going to get into exactly what that means. But the interest rate, this is going to depend on the lender I use and the size of that loan, typically ranges between 3 to 4% with most lenders. It is very, very common to attain a 3% loan interest rate. Some banks do have minimums where you'll see a 4% loan interest rate. That can happen if I have a policy with a bank that has a lower minimum. Maybe they have a minimum of $25,000 to $50,000, meaning I have to have, call it $25,000 to $50,000 in cash value. I assign that as collateral to the bank, and then I have a $25,000 to $50,000 line of credit. That's very low. Some banks have minimum requirements, typically around $70,000 or $80,000. So I've got to have a decent amount of cash value in the policy. If I have, call it $100,000 or more, it's very common to attain a 3% loan interest rate. Very common to see that. If I have 7 figures, often we can attain a 2.75% cost to borrow. So that's the loan interest rate on the line of credit, and that's based on interest rates today when this video is being shot. which is the beginning of February. And then what I'll also add, I have seen this, we don't do this at our company, but I know someone who does. You can work with brokers that will go shop a number of banks and find even a lower interest rate. The lowest I've ever seen has been 2% with respect to these cash value lines of credit. And how that works is, one, the line of credit, meaning the amount of cash value you have, typically has to be a minimum of 7 figures, meaning you've got north of $1 million in cash value, usually a bit more than that, and there's a 1% broker fee. So whoever the broker is that you're working with, if it's $1 million, for example, there is going to be a 1% fee that he receives. That's $10,000 if we're using a $1 million loan balance or cash value balance in that case. But he may be able to attain you a 2% loan interest rate. Depends on banks and rates at the time. But that's just a little bit of information with respect to the loan interest rates. And again, what you're doing, you're taking your cash value to the bank, saying, I'm going to assign it to you, bank or lender, as collateral, and they give you a line of credit. Now, how it works with that collateral assignment is, again, let's pretend that you're the bank and I've got my policy. I say, I want a line of credit. I've got $100,000 in cash value. You say, okay, we're going to place a collateral assignment on your cash value, Steve. So specifically what that means is once that collateral assignment is placed, I, as the policyholder, cannot go into my policy and borrow directly against it unless you, the bank, sign off on it first. So if there's a collateral assignment and the assignment is made to you, the bank, you have an element of control now over my policy. I can easily draw against my line of credit that I have established through you, but if I want to change owners, change beneficiaries, take a direct policy loan, you are going to be notified of that, and more often than not, you're going to have to sign off if there's any type of financial transaction or if I attempt to change ownership. You will be notified. You have to be made aware of that. Now, this piece, sign off on the insurance company's paperwork on the collateral CA form. That's the collateral assignment form. So in order to establish a collateral assignment, both the policyholder, let's pretend that's me, and the bank, let's pretend that's you, must sign off on a collateral assignment form on the insurance company's paperwork. Typically, the agent provides that to you, the policyholder. There's also an application with the bank that is typically very, very short and sweet. It's usually a 1 to 2 page PDF. It's unlike other applications with banks. This is a very quick approval process. It's a short application. But what I want to add here is when we apply for this cash value collateral loan on the bank's paperwork, we actually check off if this loan is for personal or for business purposes. What's important about that? If it is for business purposes, that does generate a potential tax deduction, and it makes it very easy to deduct the interest, again, if it's being used for business expenses. Of course, this is not tax advice, and we always want to consult with our tax advisor or CPA, but we have seen many people successfully deduct the loan interest, and it's very easy because this is a direct loan with a bank, and we're checking off that it is a business loan. Of course, it should be used for business purposes if we check that box off business purposes. Loan to value ratio. So with most banks, at least the ones that we recommend and the ones we work with directly, typically you will see a 95% loan to value ratio. So going back to that $100,000 in cash value, if that's your net cash value, that means the bank will offer you a line of credit typically up to 95%. There are some banks that do a 100% loan to value ratio. What you'll see though is a little bit higher loan interest rate. In my experience, I've seen banks that go 95%. I can attain that 3% loan rate versus one that goes up to 100% loan to value. They've got a floor of 3.25%. So just some nice things to consider there, or really that's my effort to provide more awareness. Minimal underwriting, we touched on that it's unlike other applications with banks or lenders. The approval process is typically 1 to 2 weeks on average. Sometimes it's quicker, sometimes it's a little bit longer if the collateral assignment form needs to be notarized or something like that. Some companies like Guardian actually do require that the collateral assignment form be notarized. So what that means is, with my policy, for example, with Guardian, if I want to obtain a cash value collateral loan, I have to sign off on the collateral form, have it notarized, and then provide it to the bank. They sign off, have it notarized with their own notary. Banks usually have that, and then provide it to Guardian. So that could delay the approval process a little bit. For the policyholder, so let's assume you have a cash value collateral loan established. You will be obligated to make interest-only payments while a loan is outstanding. So to demonstrate, I take this $100,000, I've got cash value of $100,000. Let's assume that I get a $100,000 line of credit, just to make the number simple, 100 grand, and I don't draw anything on it. There's no loan outstanding, so I have no interest. Let's assume that I take out $50,000. I take a $50K draw against my line of credit. Each month, I'm going to have simple interest due on that $50,000, or whatever the total loan balance is at the time. But I'm obligated to make interest-only payments. With most banks, you will have an online portal, very easy to manage, very easy to use, which I'm always a fan of technology and such. And then a lot of banks will also give you a checkbook, which gives you the means to write checks against it. A lot of people like that. For the agent, a responsibility here. So we work with a number of banks. There's one local bank that I really like to work with, as we've got a good relationship with them. But the agent is responsible to provide policy status reports to the bank. So if you have a whole life insurance policy and you're trying to set up a cash value collateral loan, the bank wants to see a status report, which is basically a client audit report displaying how much money you have in net cash value, are there any loans outstanding, and typically they want that dated current, meaning if they request it on February 1st, they want that status report to read February 1st. They don't want an old one. It's very important to keep things up to date there. So when we initially apply for that loan, or I should say that cash value collateral loan, a status report must be provided. If you ever want to increase your line of credit, so let's assume that you have a line of credit set up with $100,000, but then you dump in another $100,000 into your policy. Let's say you add money into PUAs, whether it's $10,000, $50,000, $100,000, whatever it might be. When you dump money into your policy, your cash value increases. What you can do is request an increase in your line. What the bank will ask for in that particular case is an updated policy status report. Mainly, they just want to validate that you have added the money to the policy, and then they will increase your line. I'll add that some banks place a limit on how many increases can occur per year. Some don't, but that is good information to be aware of up front. But I can dump money into a policy, then request that my line be increased, and your agent, if you're working with us, we do this for you, provides that to the bank, and then your line's increased. That typically does not require a new application or paperwork. It's usually a very, very seamless process. So what I will add here is, with cash value collateral loans, a potential drawback or some people have discomfort is I am working with a bank, and if I have a loan outstanding, I must make interest-only payments. If I die with a loan outstanding, the bank must recover their money. So what's going to happen in that case, if I have a $500,000 death benefit and a $50,000 loan outstanding with the bank is first paid the $50,000 that they're due, and then the remaining death benefit goes to my beneficiary, the other $450 in that example. So it can impact the death benefit there. But where some people dislike it, or just again express discomfort, is the fact that they have interest-only payments due to the bank. Versus a direct policy loan, the cost to borrow is a bit higher, but you've got full control. You can pay the loan interest and loan balance however and whenever you want, and if you want. We don't even have to pay policy loans back, provided we don't loan too much money. But we've got a ton of control with direct policy loans. That's an advantage with a policy loan and not a cash value collateral loan. And then if we ever want to exit the cash value collateral loan, we do have to pay it off. That is very simple though. One, we can pay it off if we have the cash. If we don't have the cash and we want out, or if the bank decides to call the loan, which is extremely rare, but if they do call it or we want out, what you can do is just borrow directly against your life insurance policy to pay the bank off, and then you're back to where you would have been if you never went with a cash value collateral loan in the first place, if you just would have borrowed directly against your life insurance policy. Fun stuff, right? So let's look at some models here. What I want to look at here actually, before we get into the models, is this. Did you know that if you have an existing policy, you can actually refinance it. This is kind of a neat thing that a lot of people aren't aware of. If one has a policy loan, let's say it's at 5%, maybe it's an older policy at 8%. We recently had 2 cases come to mind. One is an individual with an old policy with an 8% loan rate. He had it was something like $600,000 or $700,000 outstanding in policy loans. What he did was just refinance his existing policy loans that were at 8% with the bank through this cash value collateral loan. Now he has a loan interest rate of 3%, so he saved himself 5 points on interest. He said, hey, this is great. I love the idea of having control with my life insurance policy, but to save an extra 5%, yeah, it's a no-brainer. I'm interested in that, and that's what he did after we weighed out both options. But we can refinance an existing policy loan. So I can take a policy that perhaps has a loan interest rate of 5% or 8% and consolidate it to 3%. Now, here's what I want to touch on here to provide a little bit more information on this. This is kind of cool. And you can tell you're talking to a true insurance nerd when someone talks about how cool the numbers are. And I'm making fun of myself there. So here we go. On the left, we've got a direct policy, an example of a direct policy. So let's assume you've got $1.2 million in cash value. This is based on an actual case, someone who just was approved for a cash value collateral loan. He had $1.2 million in total cash value, not assuming any outstanding loans. That's what he's earning dividends on, the full $1.2 million. His net internal rate of return, this policy is a number of years old, is just about 4.5%. So if we take 4.5%, that's the net growth rate of $1.2 million, that's $54,000 in cash value growth he experiences with no payments. He's actually not paying into it anymore. He went reduced paid up. He's beyond the first 7 years. But he's got a $1 million policy loan outstanding. The cost to borrow, the loan interest rate that goes to the insurance company is 5%. 5% of $1 million is what? $50,000. So a lot of people look at this, he does, he's a real estate investor, he says, okay, I like the fact that I had 1.2, I borrowed $1 million, so I've got remaining cash value of $200,000. That's his remaining equity that he has not accessed. But when I look at this example, I'm really only net positive $4,000 because the net growth rate based on the full 1.2, which he's receiving that, is $54,000. But my cost to borrow is a bit higher. Yes, I didn't loan the full 1.2, so I'm earning 4.5 on the full 1.2, but I've got this 5% cost to borrow on $1 million, so $50,000 in an expense that goes to the insurance company. I'm net $4,000 or net positive. Okay, I'm positive, but it's close to a wash. And I can borrow another $200,000, but what happens if he takes a loan for the full $1.2 million? At 5%, $1.2 million would result in $60,000 in loan interest expenses when he's only earning $54,000. So that's where people look at it and say, that just doesn't feel right. I'm not comfortable paying more than what I'm earning. And I get it. I mean, I'm not really comfortable with that either. So as an alternative, here's a cash value collateral loan. Same exact policy, $1.2 million in cash value, IRR at 4.5% gives him $54,000 of net growth. Exact same thing. But what we did, because he had a $1 million policy loan outstanding already, is refinance it with a bank. We literally took the policy to the bank. He applied for a cash value collateral loan, was approved very quickly, $1 million. The loan cost to borrow, the loan interest rate is 3% initially. We're working on getting that a little bit lower. But here, even at 3%, net cost to borrow is $30,000, where his net growth rate is $54,000. So now instead of being positive only by $4,000 when we look at the difference, he's positive by how much? $24,000. And then secondly, he's using this for real estate investments. So he's going to check off what? I made the screen small, but if you can see that, that's a business loan right there. So he checks off the box for a business loan. And then if he can take advantage of a tax deduction on that $30,000, that makes his effective growth rate or his effective spread even more attractive. What we have down here in gold Maximum line, $1,140,000. What that number represents is 95% of the total cash value of $1.2 million. And as that continues to grow each year, his line will increase with it. We just have to provide the status reports. When I say we, my office as the agent, just to make sure that we keep things up to date, which we do. We've got a whole department set up for that. So let's look at some numbers here and have some fun. What we will begin with. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.